Investing is a principal tool to reach your financial goals. Many have heard about investing from relatives, friends, or social media celebrities. Nonetheless, most discard this information as false. The reasons why society might neglect this precious source of money are threefold. You think it's a fairy tale where 1 in a million can succeed. If someone asked you what you want to do, would you answer, make millions by investing? For many, such an answer will be equal to saying, I'll work in a traveling circus, or I'll build a spacecraft. It sounds more like gambling than work, but only because most fear it. You believe you must be a broker or have researched the market for years to comprehend this fear and make money from it. Yet, you don't need to know how to assemble or fix a car to enjoy driving it. Similarly, there is no need to stay in the library on the weekends to receive passive income. You just need to understand the basic principles. You assume that those who invest already have a huge salary or additional income, and that's why they have a better starting point. However, that's one of the key advantages of investing. Even small sums can make a tremendous difference. Abandoning your fears and preconceptions will help you reach financial freedom faster. You will still have to put time and effort into the process, but it will be worth your while. You'll understand how powerful investing is when the income takes you to the Maldives, pays for your car, or makes your dreams come true without hard work. Thus, prepare to discover the critical elements and ways of investing, like the financial market, stocks, bonds, and dividends, to build a substantial income and improve your financial situation. Money multiplies when it works, not when it rests in your bank account. The work harder to earn more rule doesn't apply anymore. Search for additional financial sources, as your life can change and your salary may need to be revised to cover your needs. Thus, have a plan B, like a financial cushion. The modern world offers many options. Start a few businesses, participate in different projects, or combine a few jobs. Nonetheless, overburdening yourself with tasks will lead to burnout and exhaustion. Therefore, you must investigate the benefits of investment to change your perspective and life. Centuries ago, people could buy food or clothes only by offering something in exchange. It was a give-and-take deal. Now, however, you can let your finances work for you. It means that at some point, money starts making money without your effort. For example, you could have made a significant profit if you had invested in Netflix, Apple, or Tesla. On the contrary, you would have lost much of it if you put your savings in the bank. Inflation is an inevitable force lowering money's value. Therefore, you cannot buy as many products for $100 as you could have bought 10 years ago. Undoubtedly, investing takes time to master, but you can change your life's quality with consistency and dedication. Research is the first substantial step toward your financial growth. Therefore, keep up your optimism, desire to succeed. You'll be grateful you persevered and trusted the process while drinking a cocktail on a beautiful sunny beach or buying a new house. Moreover, investing gives you time and the opportunity to appreciate more valuable things. That's why stocks and bonds are the best options for money growth, as they don't require you to participate in anything. You can gain profits from both in the following ways. Appreciation, your profits grow with your assets' value. Interest payments, you receive interest from a loan you give to a business, government, or an individual. Dividends, the company gives you a part of its income because you own several stocks. Thus, investing in businesses, real estate, or any other asset can bring a considerable profit. Your money should work for you in all ways possible. And the more investment options you use, your income will increase. Study the market before contributing your money. The financial market is where you exchange stocks and bonds. People buy stocks to become co-owners of a company and receive dividends from its profits. The corporation sells these assets to generate capital for its growth. If investing were a foreign language, the financial market would be its alphabet. You must navigate it effortlessly to coordinate your investments successfully. But the market is unstable. Stock value often depends on political and economic situations. Extreme conditions are compelling as they determine the pace and intensity of inflation and can turn a seemingly successful company into ruin. The price of products and services will rise, preventing customers from buying them. For example, war can considerably affect a business's profit. Accordingly, firms producing medical and warfare goods will have the highest income. In contrast, art or leisure-oriented corporations may suffer a crisis. Therefore, your profits depend on the economic situation too. Here is how it works. When the company's revenue decreases, its share price also lowers. Hence, your stocks will also fall in price and will bring lower dividends than before. Although many financial advisors claim they can foresee the market's collapse, no one can. People may only guess how the situation turns out for different companies. For example, no one could have foreseen the immense success of the Bitcoin cryptocurrency. At that point, investing money in such a novel source sounded like gambling rather than an actual investment. That's why many missed their opportunity and lost a lot of money. Understanding the market's unpredictability and instability allows you to save and multiply your finances. One crucial principle is never putting your eggs in one basket. In other words, divide your money and invest in different companies. For example, if you invest in 5 businesses and one collapses, you will lose only 20% of your revenue. Also, try other investments, but ensure you understand them and know their possible pitfalls. Most people invest in companies they are loyal to. Study the market and choose the companies you like and trust, like Disney or Coca-Cola. Being a successful investor requires planning the stock market is a way to reach your goals and live your desired life. Nevertheless, prepare to prevent mistakes newcomers often make when they start investing. For example, you can sell your stocks without profit if you leave too little money for your everyday life and need it now. You can also fall prey to panic and fear and withdraw your money when the market slumps. Therefore, ensure you follow these principles to avoid numerous errors. Establish a consistent source of revenue. Even a small but regular sum every week can make a difference in the long run. That's why you must have a job that guarantees income no matter what. Meet your financial obligations. Create your emergency finances. A financial cushion is a particular sum of money you keep for unpredictable or unfortunate situations like job loss, health problems, or other issues affecting your regular income. It should be enough to cover your expenses for a few months. This fund is a safety net, preventing you from borrowing money or forsaking your financial goals. Develop a portfolio strategy. Research and study the market before choosing 1 or 2 assets. If you need clarification on their safety or profitability, ask for help from financial advisors or brokers. Obtain adequate insurance. Insurance can save money in emergencies and give you peace of mind about your long-term goals. Determine how much risk you can withstand. Investing can be stressful. You barely make ends meet and cannot sleep because of the sad gossip on the market. Estimate your threshold of risk tolerance and act accordingly. You can start slowly and invest little sums in 1 or 2 businesses if you still build up your confidence in this trade. Diversify your assets when you are ready. Discover and analyze the trends. Stay up to date in the business world and add new assets when ready. These straightforward, practical tips can multiply your finances, add courage, and help prevent common investing mistakes. Knowing where to invest is a top priority. After you set your goals, consider many things before investing money in any project or business. Giving your savings to an unreliable source is like lending money to someone you just met on the street. Hence, the essential question is, where to invest? Let's start with stocks. You can buy 2 types of stocks in the US. Common stocks. As a shareholder, you can vote in the company and get dividends according to the company's performance. Preferred stocks. You get fixed dividends no matter how the company performs. If the firm fails, this group will be the first to receive money. Thus, the first group is riskier than the second, as their income depends on the company's revenue. Nevertheless, they can receive more money if the business succeeds. Another aspect you can estimate is the market value of a company. You can choose between these kinds of corporations. Large companies with over $10 billion in market capital, like Walmart or Apple. Medium firms with a value from 2 to 10 billion. Small less than to billion businesses. The more significant the company's capitalization, the less risky it is for the investors. However, the new small-value enterprises can bring more income as they have a high growth potential. After all, Netflix was once a small-cap company too. Regarding bonds, the risks are much more evident than in stocks. You won't get income if the entity fails or you withdraw your money before the agreed term. Bonds differ by the source issuing them. Government. You buy those from the country to help develop infrastructure or pay the debt. Municipal. These assets are tax-free as the government issues them. They are used to complete local projects like building hospitals or roads. Corporate. These are high-risk bonds, as the company can go bankrupt and fail to repay the money. The next step to diversify your investment portfolio is to decide how to buy the stocks or bonds, individually or through a fund. Individual bonds offer limited options. You must have a lot of money to buy assets from different companies. Thus, you can lose your savings if you contribute your finances to one or two soon-be bankrupt businesses. On the other hand, funds allow you to buy various assets, reducing erroneous investment risks. Investing is a complex process that starts with a why. All investments are risky, but some are riskier than others. Wealth demands strict calculations, so your arguments for or against a firm should rely on objective data. There are 5 essential aspects you must consider before putting your trust and money into a particular business or fund. A revenue and objectives of the preferred corporation. Every publicly traded company must report yearly describing their financial state, income and expenditures, short and long-term plans, and competitive strategy. Hence, pay attention to the business's debts, the primary revenue sources, and other aspects that can clarify its current situation. The development of its value over the years. Check significant rises and declines yearly and see the situation overall. The key is to analyze the tendency of the company's growth, the business's main goals, and how they expect to do in the future. You can find this information in the annual report on the corporation's website. Focus on new goods, markets, and other ways of expanding the business. Any costs or fees that come with investments determine how much money you'll need before investing in a specific fund or a company, because higher fees entail smaller investments and profits. Other things, like how well a company has been run and how often it has been featured in the news. Any entity is the sum of its components. The same rule applies to a firm or fund. Sometimes the employees can tell more about the company than its business plans. For example, a CEO's scandal can cost a corporation a few $1 million. Most enterprises try to lock their skeletons in a closet. Therefore, check newspaper titles for the corporation's turbulence. The fewer of those you find, the more profitable your investment can be. Finally, the press may reveal an organization's educational history and financial experience, which is critical when managing people's money, including yours. Seek other sources of information to become a confident and reasonable investor. Knowledge and experience differentiate gambling from earning, so give yourself time to make mistakes and learn. After all, you have nothing to fear if you commit yourself, do your homework, and keep an eye on your investments. Did you know? According to the U.S. financial statistics firm Statista, 55% of adults in the United States invested in the stock market in 2020. Conclusion: investing is one of the surest ways to increase your money's value. Many of the world's wealthiest people contribute a considerable net worth to profitable businesses. Nevertheless, fears stop most people from even trying it. Investing involves risks, but so does putting money in the bank or hiding them in your closet. Inflation can destroy your money just as quickly as a mouse can eat your cash. Furthermore, savings do not multiply, they melt away, while investments force finances to work for you. You can start this trade before you earn $1 million a year or when you read all the books on stock markets. The most critical step is the first one, so start by determining your goals. It's crucial to keep up motivation if you fail a few times. Then do your homework. Your investment success relies on extensive research no matter what assets you buy, whether stocks or bonds. More than finding a business for investing is needed. You must consider probable risks, balance real-life expenses and savings, and ensure you understand that it is a long-term game. You don't invest when you want to buy new trainers. You do it if you dream of running in new trainers on a Bali beach in your 40s or 50s instead of going to work. Hence, determine your long-term goals, study the investing options, pitfalls, and tips, and set off to your dream life. Try this. Here is what you can do to start your investing journey. 1. Read a few books or watch videos on investments. 2. Calculate your income and determine how much you can save. 3. Select a fund or a few companies you want to invest in. 4. Make a habit of diversifying your investments over time.